Howard, like the rest of us, you've been trying to make sense of this pandemic and its implications for the economy and for companies. What conclusions have you reached?
Well, the most important conclusion, Erik, is that, as I put it, we all have the same information about the present and the same ignorance about the future. There are very few facts about the future, and there are very few historical precedents or patterns to rely on.
That's true. I'm not going to deny it. But the question every investor is confronted with right now is, how do you put capital at risk with any degree of confidence when the outlook is perhaps, as you say, more uncertain than at any time in modern history?
And that is, of course, the great dilemma, because investing is only about positioning your capital to profit from future developments. And yet, I always say we don't know what the future holds, more so today probably than at any other time in my life. I think the first thing you have to assume is that life will go on. We will continue to have an economy. We will return to shopping and working and eating in restaurants and children going to schools and people traveling and taking vacations and so forth. But of course, we also have to make allowances for the possibility that life will be different than it was in the past. I always say that the four most dangerous words in the world are "it's different this time," because people use those words to rationalize breaks from the past. Well, today we're living through a massive break from the past. There will be differences this time, and we have to try to imagine them and allow for the possibility in our analysis.
What kinds of differences do you anticipate?
Obviously, many people have been somewhat productive working from home. I feel I've been probably as productive as ever in the last 2 months. I say, well, now tell me again why I have an office and why I go there, and so forth. So that could be a big difference. We don't know, but it would change a lot. Restaurants, sports events, hotels, business travel, cruise ships, shopping malls, many of these things are now in a state of flux. But we have to make assumptions about them in order to be able to move forward.
Well, speaking of assumptions, the market, as it always does, has divided itself into two camps. There are those who are optimistic about controlling the pandemic and reviving growth, and there are those who aren't. Which camp do you fall into?
Well, I think that the real divide, Erik, is the ones who think it'll come easily and quickly, and the ones who think it'll come slowly and haltingly. And I'm in the latter category in that regard. I don't see a immediate V-shaped recovery, and people are talking about the possible recovery using different letters, V, U, W. My partner, Bruce Karsh, talks about an L-shaped recovery. Some people talk about the Nike swoosh. I think that we won't have a continuous uplift of good news. We'll have good news lift mixed with bad news. We'll have a vaccine, but it won't come this year, and it won't come to everybody immediately. We need 7 billion doses for the whole world, and it's going to take a long time to manufacture those and roll them out. I will add one thing, Erik. There's another divide. There's a divide between the people who think that stocks are fully to highly priced today, given the economic outlook, And there are people who think that's okay because the Fed will make sure that the whole economy and all the markets levitate. And in many ways, that's the more important divide today. We all think that life will go on. There will be a return some part of the way toward normalcy. There will be a vaccine and so forth. But the big divide is the people who don't understand why stocks are where they are, and the people who do understand it by interiorizing the old motto, you can't fight the Fed. And that is I think, an even bigger divide today.
What do you think? Can you fight the Fed?
I think that the Fed has great power, but not forever. And I think that, first of all, I don't think it really, Jay Powell talked about the Fed having, will not have the ability to run out of ammunition. I don't know if the Fed's ammunition is really limitless. I know that the Fed can cause markets to rise and stay up as long as it buys, but I don't know if it can buy forever. We're in new territory here. Historically, the Fed has never bought corporate securities. This time around, they included corporate securities, and then they moved on to include non-investment grade corporate securities. And its buying can make these things rise, but only as long as it's buying. I think of it as kind of, we've seen these things where there's kind of a column of water and then a ball sitting on top of the water. And as long as the water's forced up, the ball stays there. Water stops, ball falls down to earth. So obviously the Fed hopes that its buying will, among other things, inject confidence into people and that they'll take over in buying. But that remains to be seen. And it remains to be seen whether that buying will be at today's levels.
Is there any reason, Howard, to expect that's going to happen? Let's just talk about the corporate bond market, but use as an analogy the 10 years that followed the financial crisis. We had QE1, 2, 3, and every time the Fed tried to pull liquidity out of the market, it seemed, investors rebelled. There was the taper tantrum. There was the fourth quarter of 2018 and other instances. Yes. Are you suggesting that the moment the Fed tries to withdraw liquidity from a market that really prices itself on solvency more than anything else, the same thing's going to happen?
I think it has to happen to some extent. This is the dilemma. Can the Fed keep it up forever? And if it doesn't keep it up forever, will prices weaken? I mean, those of us in the markets believe that stocks and bonds as well are selling at prices that they wouldn't sell at if the Fed were not the dominant force, at prices that would be determined by just the outlook for the companies. And so, number one, if the Fed were to recede, we would all take over as buyers, but I don't think at these levels. And you mentioned the difficulty of withdrawing the support. I personally believe that there is too much concern with the downside of withdrawing the support and not enough concern with the downside of never withdrawing the support. And I think that if it had been done earlier and gradually, it could have been done. And as you say, there was a bit of a temper tantrum in the fourth quarter of 18 when the interest rate on the 10-year Treasury reached 3.25. I think that was October 4th. And the market started to go down from there. So, of course, kids like candy and investors like low rates, but we have to have discipline also.
Howard, a few days ago, Royal Caribbean, the cruise line, sold more than $3 billion of debt, secured debt, I should add, at a yield of about 11%. Now, I probably don't need to remind you, but this is a company with zero revenue and very little hope of returning to its pre-coronavirus state anytime in the near future. Yet the credit market is open to Royal Caribbean. How do you make sense of that?
Number one, they'll get more back into business than everybody thinks. Because, I think there's a knee-jerk reaction to say, well, the cruise ships were Petri dishes for the infection. We have this image of people floating around on cruise ships, exchanging the disease with each other, being refused entry to ports, and so forth. Nobody will ever go back. I understand, Erik, that bookings for cruise ships in 2021 are quite strong, and that there is a coterie of fans for cruises, and they want to demonstrate their support for their beloved pastime. That's number one. Number two, the cruise lines, for example, do have great asset protection. And if you can come into a situation, and if you can buy senior debt, which will be paid ahead of all the other creditors, and it's a small amount backed by a large amount of assets, then you can feel okay about doing it. Business won't come back 100% to what it used to be, but if it comes back 75%, the people who buy that senior debt will do okay. And then the other thing is that, the Fed buying has caused high-grade bonds to drop in yield. When people look at that, they say, man, those high-yield bonds yield too much. We're going to buy them. That causes them to drop in yield. The people in the stock market look at that and they say, well, we can't get much yield from bonds anymore. Stocks look much more attractive. We're going to buy those. So those go up in price. We don't talk in the stock market about down in yield. So everything is relative to everything else. And the strong Fed participation and support of the markets has caused people to say, oh, a cruise line bond at 11 looks good to me. Non-energy high yield bonds yield about 7, 400 extra basis points for taking the risk of a cruise line with good asset protection. We'll do that. And so they get sold. It's what happens in a market which is, I would say, artificially supported by Fed buying.
So let's talk a little bit more about the artificiality of it. In your opinion, Howard, would Royal Caribbean be able to sell secured investment grade debt at all, or just secured investment grade debt at a yield of 11% if the Fed weren't backstopping the market?
I don't know Royal Caribbean. I don't even know if it's Caribbean or Caribbean, but I don't know that company that well, and I can't, and I wouldn't comment on any one company. But I think it's fair to say that there is a yield at which they can sell well collateralized senior debt, even if the Fed were not in operation, but it probably wouldn't be 11.
Howard, you've made a career, and I should add it's been a highly successful one, out of understanding and explaining cycles in financial markets. Will this cycle look like past cycles?
First of all, Erik, this is not a cycle. This is an episode. Not everything that goes on in the world is part of a cycle. There are exogenous, idiosyncratic events as well. So, a cycle, and of course, you're trying to plug my book, Mastering the Market Cycle, and I greatly appreciate that. But a cycle is kind of a regular pattern of ups and downs. There's a trend line, let's say GDP. The trend line of GDP in the US grows at 2% a year, but sometimes faster and sometimes slower, and sometimes it shrinks in recession. So there are excesses and corrections and excesses and corrections, fluctuations. This occurs throughout history. It occurs in economies, in companies, in psyches, in civilizations, in many things. Regular, not in the sense of being consistent in length and amplitude, or even reasons or impact, but regular in the fact that it tends to happen over time. This is not that. This is a meteor hitting the earth for reasons not having to do with excesses or corrections or people's activities. This is what we call an exogenous impact. And it hit the earth and it changed life as we know it for the last 3 months. And it had economic impact, but the nothing that's going on came from within the system, within the economy, within the companies, et cetera. And so this is not subject to cyclical analysis. Now, we think there'll be a recovery, and the recovery may look like the recovery from past cyclical declines. And it is the speed and strength and duration of the recovery that everybody wants to talk about, and that will feel cyclical.
I did actually have your book in mind, believe it or not, Howard. There is a chapter in Mastering the Market Cycle on the distress cycle. Yes. And in it, you talk about things that we've discussed many times before and which many people have in mind, right? What precedes a turn in the cycle? Complacency, perhaps some excess. Some would argue that we were there in January and February. And that's what you describe as stacking the logs in the fireplace for the next bonfire. And then there's an igniting event. Right. That produces a recession. We could talk about this as being an igniting event, even if it's a meteor in its scale, and conflagrating power. And then some things are supposed to happen, right? Companies are supposed to be locked out of first of all, corporate profits collapse, and that's happened. Companies are supposed to be locked out of the credit market. There's supposed to be defaults. There's supposed to be bankruptcies. And then risk capital is supposed to come in at the right price, seeking outsized returns, and help the economy to recover. That's what I'm getting at. Is that going to happen this time? Some of those things seem to have occurred, but we've also talked about things that appear to be different this time, like, for example, the Fed's participation in the corporate credit market.
Well, Erik, you did a great job of describing that. You don't need me. But yes, there are things missing. First of all, you talked about the credit window closing. I forget what your words were, but that's the common terminology. You get when we get a recession and we get an adverse reaction in the markets, we get a rising fear factor, or you might say increasing risk aversion, and the credit window slams shut. And whereas 3 or 6 months ago, anybody could borrow any amount of money for any reason or no reason, now nobody can get any money. And people who need money default, go bankrupt, et cetera. And there's a cleansing out of the weak from the market, and the strong come back. But this time, in order to minimize damage, well, minimize sounds like a ridiculous word in this context, to limit the damage to the economy, the Fed and the Treasury sprung into action, not in months as they did in the global financial crisis, but in weeks, and started to inject large amounts of money into the economy and into the markets. And so that has limited the extent of the credit crunch. There are still companies that are desperate for money in order to avoid default, and some that the Fed and Treasury actions are not reaching, which will have problems. And the rating agencies and the investment banks are predicting that somewhere between 15 and 25% of all the high yield bond issuers, for example, will default in this cycle. So the Fed has not eliminated the negative impact, but it has limited this. And the cleansing out of the weak and companies, and especially the, I would say, punishing of risky practices that led to the down cycle, cleaning them out contributes to the upcycle. That has been forestalled at minimum as well. If companies, for example, levered up, when you take on more debt, you lever or magnify the return on the equity, but you also limit or reduce the company's ability to get through tough times. And people who do it too much, there's a bankruptcy that occurs, and the old owners are wiped out, and the old creditors become the new owners, and there's kind of a revival process. And to the extent that the government take action and gets involved, that obviates that.
Howard, you quoted a most memorable line in one of your recent memos: "Capitalism without bankruptcy is like Catholicism without hell." It really is an incredible line.
Yeah. And I didn't make it up.
No, I'm aware. You said it's been variously attributed. I guess my question around that is, if in fact there aren't as many bankruptcies this time around because of the fact that the Fed, and I should add the Treasury Department, are doing everything they possibly can to support the economy, and if in fact there's less of what we might call a distress cycle, right, as a result of that, what are the consequences? First of all, do you agree that it appears as though it's not a matter of agreeing. Does it appear to you as that there will be less of a distress cycle? And if there is less of one, what are the consequences?
Well, you didn't finish your sentence, Erik, because you said, do you agree that there would be less of a distress cycle? And you have to say less than what? Less than usual?
Yes, I suppose.
Or less than there otherwise would have been? You know, you have to finish that sentence.
Right. No. So let's go with that as the premise. Yes. Less than normal, less than there would have been, less than the global financial crisis, less than whatever you choose to use as a comparison.
We are living through the worst economy that almost anybody alive has ever seen. You have to be over 80 years old to go back to the 30s to have seen worse, and maybe we're even worse than that. It's believed that the unemployment rate will hit a higher level than was achieved in the Great Depression. People are talking about second quarter GDP being down 30 to 40%. As far as we know, I mean, there aren't good quarterly records, but as far as we know, there's never been a quarterly decline in GDP to that extent. So we're in the worst economic environment, let's say ever. And you would think that that would bring on the greatest distress ever. It may not happen because of the Fed and government action. I think we'll still have a very substantial distress episode. In 1991 and in 01-02, we had 2 years of 10% defaults in the high yield bond universe. We may have 20% defaults in high yield bonds anyway. And there are still lots of highly levered companies and highly levered investment entities that desperately need large amounts of cash to avoid a meltdown. And, some of them will not get what they need and some will melt down. The other thing I want to mention, though, is the impact on society, because there is a concept called moral hazard. And moral hazard is when people who engage in risky behavior and bad things happen, which could cause them to pay for their risky behavior, are supported and sheltered from the risky behavior. And that's the importance of the quote about hell. In order for business and investment to function as it should, there has to be a fear factor. I am afraid of losing money for my clients. That causes me to be conservative, and that has shaped my career. And, my Oaktree colleagues, Bruce Karsh, my partner, we both embody this conservatism, and it has caused us to stay high in the capital structure and try to invest in companies which have better futures, even if they are financially distressed. When people are not afraid, when people believe that they can engage in risky financial practices and will be sheltered from the impact, that creates a risk-prone aspect of society, which I believe is not desirable for economies and companies and markets.
Howard, some people would say we were already there. In the 10 years that preceded this pandemic, corporate borrowers were increasingly capable of levering up more and more, and the stock market, and for that matter, the bond market in some cases, rewarded them for doing so.
Yes.
Now you have a number of isolated examples that bring to mind what you just said. The airlines, for example, which collectively, US airlines used 96% of their free cash flow that they generated between 2010 and 2019 to buy back stock, obviously by borrowing a great deal to do so, and now they're being bailed out by the government. Now that may be isolated to the airlines, but it kind of addresses the point you're trying to make. If that's where we are, and if that's where we're going to be after the crisis of this pandemic is over, Howard, and financial markets and society and the economy return to something more akin to normal, what does that mean? If there is no punishment for bad behavior, for recklessness, where do we end up?
You know the answer. If there's no punishment for the results of bad behavior, then bad behavior will continue and increase. The airlines did not. I don't think the airlines did the stock buybacks in the expectation that if there was an economic crash and their business went to almost zero, the government would bail them out. I mean, they may think that in the bottom of their minds, but I don't think that was part of the plan. The point is that the up part of the cycle, the economic expansion and the market rise went on too long, and that tends to drive out caution and prudence. Back in the early 70s, somebody gave me the gift of telling me about the 3 stages of the bull market. The first stage, when only a few intelligent people believe there could be improvement. The second stage, when most people accept that improvement is taking place. And the third stage, when everybody and his brother believes things can only get better forever. So if you go on long enough and you reach that third stage and everybody forgets about the pain of the global financial crisis and everybody forgets about the possibility of a downturn and everybody thinks that good times will roll on forever, then you would take on more leverage, do stock buybacks, engage in risky practices. You look back, you say, well, for the last 5 years, the person who took the most risk made the most money. I'm going to join that too. This brings on this type of behavior in and of itself. And of course, it's unhealthy. And it eventually culminates in the reaching of a top and the turn down from the top. I've been very cautious in recent years. As you know, my view of the market was that it would characterized by a high degree of uncertainty, low prospective returns, high asset prices, and risky behavior on the part of people trying to get high returns in a low return world. And those 4 things told me and told Oaktree that we were in a risky world. I said it for years, and I was too early. By the way, another of the great adages in our business is that being too far ahead of your time is indistinguishable from being wrong. We were too far ahead of our time. We were conservative for a good many years, but we believed that because of the conditions I enumerated, the market was vulnerable to an exogenous influence, a shock, something that would make it decline. Now, what people said to me is that people were not crazy. They were not euphoric. They weren't out of their minds. People used to say to me, I know the good times can't roll on forever, but I can't think of anything that could make it stop. And nobody could. We didn't see the seeds for recession or inflation or anything that would make it stop. guess what? Something unimaginable to most of us arrived as an exogenous influence and did make the good times stop rolling on. And that's what we have now. But but the conditions in the market created a vulnerability to an exogenous shock, which exacerbated the damage of the virus.
Some people would say that the Fed has no choice but to step in and do everything it possibly can, Howard. But by doing what it has done, do you worry that it has set the stage for more recklessness in the future?
First of all, Erik, I am absolutely among the people who believe that the Fed had no choice. Thank God that it did what it did. We were, Bruce and I were, go back to March 18th or 19th. We were just actively discussing the possibility of a global depression, of a multi-year, very serious economic impact. And the Fed and Treasury and other central bank actions have, we believe, prevented this. And nobody's talking about global depression anymore. So I'm absolutely among those people. But it's very important to note that just because something has unforeseeable negative consequences, that doesn't mean it was a mistake. I believe that there may be negative consequences from these actions, but certainly that doesn't mean they shouldn't have been undertaken.
For now, the Federal Reserve has drawn the line at fallen angels, investment grade bonds that were downgraded to junk. And we've talked about what that has done for the investment grade market. And the Fed is also buying, at the moment, high yield ETFs.
Right.
What if, Howard, the Fed goes further into junk territory? What if it decides that it's okay to buy double Bs or perhaps even lower rated debt?
Well, Erik, there are also people who believe that one of these days the Fed may turn to buying common stocks. So, the buying of corporate bonds is a first. And what they've demonstrated is that there are no tactics that they won't engage in. There are people who believe, by the way, that it violates the rules under which the Fed acts, but they're doing it anyway. And they'll argue later about whether or not it was okay. Yes, they'll do anything. Their arsenal has been described as limitless. I still believe that it'll only work as long as it works, and as long as they're actively doing it. Look, Erik, what if the Fed said, we're going to be the buyer in every transaction? Every bond transaction, every stock transaction, we're going to be the buyer. The Fed has an unlimited checkbook. Our checks never clear, so we're gonna buy forever. This Fed has increased its balance sheet up to 10 trillion. There's no limit. We'll buy them all. Well, in theory, they could do that, and in theory, if they bought aggressively, they could make all the markets rise. Now, everybody would know that that's a Potemkin market, that it's a fake. And the minute they stopped, things would collapse. Certainly the Fed buying would drive out all private buying, because we'd all know that the Fed is paying too much money. The question is there any reason why they couldn't do that? I don't know. In one of my memos, I said, why doesn't the Fed just send out a check to $1 million check to every American? It would only cost $350 trillion, and we'd all be rich and prosperity would return. And so the question is, facetious, the question is there a downside to things like that? Would there be negative ramifications? I have to think so. I don't know what they would be. So will there be negative ramifications to the Fed's buying of fallen angels and high yield ETFs? I don't know. Would there be further ramifications if they bought single Bs, if they bought common stocks? I don't know. I believe so. Here we are, our GDP is 20 trillion, and we have done securities purchases and stimulus and support in many trillions in 1-2 month period. Are there limitations to what can be done? And are there ramifications? I believe so. But, this is not a science. We'll see what they are.
Howard, how do these considerations and concerns affect what Oaktree is doing, affect what Oaktree is buying, and when Oaktree is buying?
Sure. Well, we were a very active buyer in the public debt markets in mid-March. And then on the 23rd or 4th of March, the government and Fed started to talk about what their program would be. And around the 26th, they announced it. And that drove up prices in the public credit markets to the point where we're not buying as aggressively at this point in time. So it has changed the market from what it would have been if they hadn't gotten involved. And that has had impact for us. I think that's inescapable.
Do you think investment opportunities are likely to improve from this point forward, where you will see the opportunity, the possibility of making elevated returns again? Or are we sort of here now and here for the time being?
Well, you tell me, will the Fed decide to be the buyer on every transaction? In which case prices don't ever have to go down. In theory, Yogi Berra said, in theory, there's no difference between theory and practice, but in practice there is. But let's talk about the future in a serious way. So I mentioned that the rating agencies believe, and the investment banks, that between 15 and 25 or so % of the high yield bonds outstanding will default. That's roughly $400 billion. That's a lot to buy. In April, I believe there were 19 defaults or bankruptcies, and I believe that's the greatest in history, greatest single month in history. And we're just getting going. Defaults and bankruptcies largely occur when companies run out of cash. And the fact that 19 occurred in the first full month of the crisis, and that the crisis has months more to run, tells me there'll be more defaults and bankruptcy. And there, as I mentioned before, there are large, highly levered companies and investment vehicles that the government and Fed rescue program is not likely to reach and take care of. So we believe there'll be plenty. It boggles the mind to think that we're going to have a crisis of the magnitude of this one and not have fallout. And typically, we have been able to profit from that fallout.
So is that to say that while Oaktree was buying aggressively in March, less so now, it may yet become a more aggressive buyer in the months ahead? Absolutely.
I mean, they, like they say in a football game, we take what they give us. And the greater the dislocation, usually the greater the bargains, which means the greater our buying. We think that there's a substantial opportunity ahead.
Howard, we know now that the federal bailouts and the stimulus programs that followed the financial crisis came at a social cost. One of those costs was the widening gap between the rich and the poor. You and I have talked about it. You've written about it. What do you think the costs of the pandemic bailouts and stimulus programs will be at a social level?
Well, more the same. I mean, we've had a substantial rise in populism in this country and around the world. And I would describe populism as class resentment. And the bailout from the global financial crisis was easy to characterize as a bailout of Wall Street, not Main Street. The banks were protected and brought back to life at the same time that many thousands of Americans lost their homes, to put it in stark terms. And so that gave rise to populism and a class resentment. And I think that in this go around, number one, the banks are not in the condition they were 12 years ago, and so they do not have to be buttressed in the same way. And I think it's absolutely essential, as I mentioned before, that this economic support be engaged in. But still, people will be able to say, look, they gave $50 billion to the airlines, and they gave this to that company and this to that company, and they bailed out the fat cats, and 20, 30 million Americans lost their jobs. So I would imagine that this episode will add further to that populism.
Howard, I want to thank you very much.
Well, it's always a pleasure to be here with you, Erik.